Welcome to Target Market Insights, the multifamily and marketing podcast. Each week, John Kasman interviews multifamily and marketing experts to teach you how to find the best places to invest, attract investors, and grow your portfolio. You are listening to Target Market Insights with your host, John Kasman.
Welcome to Target Market Insights. I'm your host, John Kasman, and I want to thank you for joining us for another great episode. Now, if you're enjoying this podcast, do me a favor, leave us a 5-star rating and review, and don't forget to hit the subscribe button so you don't miss an episode. Now, today we're going to be talking to Paul Moore. After graduating with an engineering degree and then an MBA from Ohio State, Paul started on the management development track at Ford Motor Company in Detroit. After 5 years, he departed to start a staffing company with a partner, and they sold that to a publicly traded firm for $2.9 million 5 years later. Paul later entered the real estate sector, where he completed 85 real estate investments and exits, appeared on an HGTV special, rehabbed and managed dozens of rental properties, developed a waterfront subdivision, and started 2 successful online real estate marketing firms. Paul Moore has done a lot in the real estate space. We're getting ready to talk to him a lot about it. But right now, he is the managing director of 2 commercial real estate funds at Wellings Capital. Let's welcome to the show, Paul Moore.
Hey, it's great to be here, John. Thanks for having me on.
Paul, it's great to have you on. Really excited to talk to you. You have what a wonderful experience. And I initially came across you through some of your writing on BiggerPockets, and you give a lot of great information, primarily multifamily, a little bit more self-storage. Why don't you take 30 seconds, though, or even a minute, and fill in some of the gaps? Because you've got a story history here, and I want to make sure we capture a little bit more of it in your own words.
Yeah, so from 2000 to 2011, did all kinds of residential flips, flipped houses, waterfront lots, did a subdivision, lease option sandwiches, all kinds of ground up construction. By the way, if you don't know how to put a doorknob on your house, don't be a residential builder. I'm just saying, okay? But anyway, I learned to make a lot of money, and I learned to lose a lot of money. And in fact, I've got a podcast called How to Lose Money, where we talk to successful entrepreneurs and investors about their pain along the way. And so that's been a lot of fun. But anyway, in 2011, I discovered commercial real estate. And like I tell some of the employees at our company in their 20s and my own kids, I say, man, if I would have discovered the power of large scale real estate, meaning multifamily, self-storage, mobile home parks, larger scale commercial real estate, I never would have done anything else.
Yeah, so let's jump into that, right? So we all know, we preach it. So most of our listeners, if you're an avid listener of Target Market Insights, we love multifamily investing for the scale that it provides. For us, a value add strategy where you have a property that is cash flowing the day you buy it. You have an opportunity to increase the value through your operations, through renovations, through cutting down expenses, driving up that net operating income, the NOI, and then being able to either refinance or sell to exit out for the profits. We love that strategy because we think it's a great way to minimize risk, right? There's risk in any investment. And certainly, I'm sure you can attest, there's certainly risk in any investment. But we like that strategy because if you're making money from day one, really what you're trying to do is implement a plan to maximize profits as opposed to a project where it's new development, where maybe you're not making money until you sell and you're done, or you're flipping a project where, again, you don't make money until you've implemented the plan. So we like that strategy a lot. But you've got the podcast, How to Lose Money in Real Estate. Talk to us about that. What are some of the crazy stories that you've heard and you've seen of how people have lost money in real estate?
Yeah, so it's actually how to lose money, and we just talk to anybody in general. But it does turn out, John, that over half of the people are in real estate, and over half of those stories are around 2008 for some reason. I can't remember why. But yeah, man, I had $1.5 million in the bank after selling my company in '97, and exactly 10 years later, in the fall of 2007, I had $2.5 million in debt. And that was fun. But anyway, if we have time later in the show, I'll tell you how we resolved that. I ended up debt-free 13 months later in the middle of the recession, but that was great. Real estate was one of the reasons. You can't, stocks and angel investments and investing in oil wells and wireless internet companies, I've done every one of those, by the way, can go to zero. And every one of those, I think, went to zero, by the way. But real estate doesn't. Now, over leveraging real estate can go to zero. But at any rate, we love real estate. We love the commercial real estate value formula because of exactly what you said. But some money loss stories. So Brian Hamrick, he's got a podcast as well. He's right across the lake from you, John, and Grand Rapids. And he has a story about how he had a single family rental that was going okay. And then he had a vacancy and somebody went in and decided that he had a meth house. And so he tells about the adventure of trying to deal with the meth house in one of our podcasts. Another one of the shows was a guy named Jay. It's a letter J. And I can't remember. He was in LA and he was investing in value-add apartments somewhere in Tennessee or Carolinas. And his contractors were taking money and taking fake pictures of all the improvements they were making, but they weren't making them. And that contractor actually apparently had done that to a bunch of syndicators. He ended up dead mysteriously, and they don't know why. Anyway, Jay had nothing to do with it, I'm sure. No, seriously. But Jay taught us a great lesson, and I want to just tell you what he said. Jay said, if you lose money, if you go through pain, if you go through failure, he said, dive back in right where you failed. Because you've already paid the tuition, you might as well get the benefit of the class. And that was so powerful. And, we are going to write a book called How to Lose Money and talk about the lessons we've learned in the first 200 episodes. And we're going to be using Jay's story and the meth house story along with a whole lot of other ones in our upcoming book.
Man, Paul, what great stories there. And I love that quote from Jay. You talked about paying the tuition. You may as well jump right back in. I think that's the thing that scares most people, right? Is making a mistake, losing money. And there's this notion that, it's okay to lose and to make mistakes, because the sooner you make mistakes, the sooner you can correct them, the sooner you can overcome them. And I will tell you too, that's one of the things that we struggled with starting out was I was so scared of making a mistake. I did so much research. We were really maniacal with everything that we did. And then the human factor comes in, right? Where you have to deal with people. And our first bad deal was due to a contractor issue. And it's just something that, we vetted the right person. We felt like it was the right person and everything checked out. But ultimately, people, they have things that they're going through that, sometimes we can't see or we don't know until they're in different situations. And we ended up losing money. And quite frankly, it was one of those things where if we would have came into that deal with the right mindset, we could have done a deal and still made money. But because we really defaulted to the person who was more senior, had more experience, we ended up losing money on that deal. So part of it for me is also understanding that it's okay to recognize that things may not work out well, but don't operate from a place of fear. Always make decisions from a place of strength. What is the best decision going forward? Don't look back and look at the money you've already invested in the deal and try to strong arm it to success. Sometimes a deal just, you can't salvage it, and it just goes bad and you have to do what you can going forward. So what were some of your takeaways from, you mentioned Jay's story and some others. What's been your main takeaway from the How Not to Lose Money podcast?
Yeah. So one takeaway. Now listen carefully to the craziness of what I'm going to tell you here. One takeaway has been keep going, never quit. You might be, I don't know if you've heard of that story about the guy who was digging a mine. I think it's a real contemporary story, and he just quit drilling for gold or whatever it was he was drilling for. I think it was 4 feet away from where the gold vein was, and he quit and he went back east. Somebody else came and picked up where he left off, and in just 4 feet of rock hit this massive gold mine. I think it's a true story. Wow. And so the lesson is don't quit, right? Well, here's another lesson. Know when to quit and quit early. What? Yeah. So a lot of the people who were on there said, you got to know when to cut your losses. You got to know when to get out. You got to get out early before you, like in our wireless internet company, we knew in the first year we were barking up the wrong tree.
Mm.
And before we wasted, I think it was $390,000 of our money and some investors, we should have got out and just returned the rest of the principal. But instead we persisted for 7 years. And it never really got much above break even. Now, wait a minute. How can you have these two completely opposite lessons? Well, I think the answer is twofold. Number one, with years of experience and good counsel, you got to have wisdom to know the difference. Is this one of those where I've got to persist and become the next, Amazon or whatever? Or is this one of those where it's just a clunker, like, I can't remember Steve Jobs, one of his big failures, 1981, whatever that one was, that computer they put out, and they just
Lisa?
the Lisa, to cut it off and cut their losses and go on. So number one, we learned that we need wisdom. We need discernment. Proverbs says, get wisdom. We got to get wisdom. And the other thing is, you've got to know if you're barking up the wrong tree or the right tree. If you're on the right path, like commercial real estate, I know that that's the right path for a lot of people. So we got to persist when we fail. Whereas wireless internet in North Dakota, that was just the wrong path for us, and we should have cut it off early.
No, it's great feedback there. To your point, understanding the path that you're on. I had a coach or mentor, and he talked about failing forward. And I think it's a similar concept of recognizing that if you're doing the right things, even if you fail, you're headed in the right direction. You'll learn from that mistake. You'll learn from those failures, and you'll get better. But as long as you're still doing the right things, if you're focused in the right areas, it's still going to pay that dividend. Kind of going back to what you said with Jay, is that you've already basically paid the tuition. So you're going to learn, get back in there.
Right.
You're doing the right thing, keep learning, keep going. And the lessons that you learn now will be more beneficial for you going forward. Paul, let's move forward. I want to talk about, commercial real estate, because you had so much success even before getting into commercial real estate. What was it that made you decide to get in the first place?
I got to be real honest with you, John. I didn't understand. I wrote a book on multifamily investing that's still selling pretty well. It's called The Perfect Investment. In chapter 8, I lay out the value formula, but I got to tell you, it was a year, maybe more than a year after I wrote that book that I really even understand what I wrote. And when it dawned on me how powerful this was, then I would say that if I could have known back in 2011, what I'm about to tell you in the next 2 minutes, that would have been the reason I would have jumped in. I'm trying to be real humble and honest here, because I don't think I knew what I didn't know. But the value formula, if you had a $300,000 house that you bought and you added, you finished the basement and you finished the attic, and you put on a huge addition, and you put in gold-plated fixtures, and you put $800,000 total in this house. If you're in a $350,000 neighborhood, you're probably not going to get your $800,000 out of this house, because residential real estate is based on comps, comparable properties. But commercial real estate's entirely different. It's based on math. It's a value formula, and the value formula, for you who know this, you probably do already, but it's the income divided by the rate of return. Specifically, it's the net operating income divided by the cap rate. And if we can increase the net operating income, and if we can shrink the cap rate, which you can't always do, then that combination can make a massive change to the value of the asset. Now throw in safe leverage, and then you even catapult your returns even further. Now, Jeff Bezos, speaking of Amazon, he went around and took all the light bulbs out of the vending machines in all the Amazon facilities in America and the world probably now, like where it says Lance at the top of the vending machine. He said, why do we need to advertise Lance? Let's take that light bulb out. Number one, it's burning electricity. Number two, it needs a replacement light bulb sometimes. Number three, there's a maintenance person who has to do that work. He knows that every dollar he can add to his income becomes something like $20 or $30 or $50 in his share price because of the leverage impact of the price to earnings ratio. Well, it's the same with the value formula. Do you know every dollar you can add to the income of, let's say, an apartment building? Listen to this. So a dollar added to the income per month is $12 per year. Good at math. And then you take that $12 a year, you divide it by an average cap rate today, a rate of return of, let's say, 6%. You just created $200 in value at the apartment level. Now that's $1 increased rent at one unit at your apartment complex. Now, what if you multiplied that by 150 units? Or what if you can take 10 vacant apartments and put in $1,000 renter into each one? You can really, really increase the value, but it's better than that because with using leverage, it makes it even better to the equity holder because the bankers don't get a piece of that, as you know, John. So, for example, this is round numbers. I want to be clear, but a mobile home park we just invested in recently, in round numbers, let's say the price was $5 million. This is a really good example for the value formula. So that's $3 million debt and $2 million equity, right? $5 million total price. Now the asset manager went in, he looked around, he said, there's 3 or 4 or 5 cars in front of some of these mobile homes. There's a boat over here and an RV and a work trailer. So that he paved an acre at the front of this mobile home park. He put in a gate and a fence, and he said, okay, if you've got one of these extra cars or whatever, you can put it in here and we'll charge you. Now, when that's fully leased up, they'll go to the neighborhood as well, and they'll offer boat and RV storage. When that's fully leased up, he'll be charging $10,000 a month. That's $120,000 a year. $120,000 divided by a 6% cap rate is $2 million in increased value. Wait, he just added 40% to the value of his mobile home park by just adding a little 1 acre paved area in the front. But it's better than that because remember, the equity was only $2 million. The equity, the $2 million, just went to $4 million, at least on paper. He just doubled the value of his shareholders, share value with just one change. And that's before a dozen other things he can do to add value. You see, this is the same in multifamily, mobile homes, self-storage. It's powerful. And John, I think this is why most of the Forbes 400 wealthiest people in the world invest in commercial real estate.
Yeah, it's very powerful. And I love that example you gave because it's such a great illustration of how you can create value, especially when you compare that to single family investing, right? So when you do that from a single family, you can do all the things you want to do, but the value is still based on the comps in that area.
Right.
Versus in commercial real estate, it's really valued based on the numbers, the cash that is generating, the cash flow, the cap rates that are available. Your example there for the mobile home is a really good example too of the different ways. It doesn't always have to be go in, gut rehab, renovate, and improve. It could be just simply seeing something that other people miss, seeing these opportunities, being creative and saying, hey, listen, you have all these cars, you have these RVs, you have these boats parked here. If we create a separate lot for that and charge for that, that's going to create a certain amount of value. So really looking at those types of opportunities is really a way that makes commercial real estate stand out in a way that other investments simply don't. And we haven't even talked about the tax benefits. Talk to us a little bit about some of the tax benefits that are available through commercial real estate.
John, a friend of mine from California said that if the American people knew the tax savings that commercial real estate investors get, we'd have another tax revolt on our hands, and this time it would be against us. Well, he said that 3 years ago, and that was before the president, love him or hate him, the current president and his friends inside the Beltway way sweetened the pot in December 17 to make commercial real estate a ridiculously amazing investment to save on taxes alone. I'll give you one example first. I'll give you two real quick. That same guy from California showed me how he could take $20 million, invest it for 10 years with reinvesting all the dividends over 10 years, And then in year 11 through 20, start throwing off dividends. Now it's 20 million up front. He would throw off 131 million in dividends over the second 10 years, and the value of the portfolio would be 210 million. And that was amazing enough. But what he told me next was even more amazing. He said, I can show you how that investor could potentially have paid zero in taxes over those 20 years and could kick the can down the road even further with 1031 exchanges and 721 exchanges. So it's pretty powerful. A guy that you and I both know in Dallas, he recently had $2 million set aside for his tax bill, and he got with his CPA and said, is there something else I could do here? He said, well, why pay the IRS $2 million? He goes, why don't you go buy an $8 million apartment building with that same $2 million? $2 million down, $6 million debt. And the light bulb went on for the guy, and he said, oh, okay. Now, here's what happened. He took that $2 million, he bought an apartment building for $8 million. Then he used the new tax law. I'm finally getting around to your question. And he used bonus depreciation, the new tax law, to save himself about $2 million in taxes that same tax year. In other words, the $2 million he was going to hand to Uncle Sam, he put in his own cash flowing asset, and he saved that same $2 million in taxes. So that's one of the amazing things that's happening right now. We don't know how long we'll have this benefit, John, but bonus depreciation is one of the benefits of the new tax law. It allows you to write off anything that, well, I probably should back up, but using a cost segregation study in commercial real estate, you can segregate the long-term fixed cost, the value of the real estate, from the shorter-term assets like roofs, parking lots, shrubbery, electrical, wiring, lighting, fixing, flooring. I'm looking around the office here. Countertops, cabinets, all can be written off in under 15 years. Well, bonus depreciation says if it's 15 years or less, from my understanding, it can be all compressed into the first year, and those losses carried forward for years to come. So that's one way to do it, the cost seg study. Second is bonus depreciation, accelerated depreciation from the cost seg study. Being a QREP, which you and I both are, John, that's a qualified real estate professional, or having your spouse be a QREP to be able to accelerate your write-offs against ordinary income. There's all kinds of things you can do. And they say you've got to die or pay taxes. Well, I would say maybe only one of the two apply, because if you can leave your assets in your name at the time you pass away, your children, or your heirs, I should say, can reset the basis to the current value and never pay tax on the stuff you kicked down the road for, decades already with virtually no capital gains.
Yeah, we talk a lot about generational wealth. For me, at least, when you start thinking about commercial real estate, I think you start thinking about the next generation, your kid's kid, and the strategies you just talked about. They are strategies that really help create generational wealth. If you are thinking about legacy, no matter where you're at currently today, but if you'd like to leave something to your kids and your kids' kids, these are the kind of strategies you need to be thinking about investing in the assets like commercial real estate, even if you have no desire to actually own commercial real estate. From a tax benefit perspective, there's so many valuable elements that make it so appealing that you should at least be considering it. You can be an active investor, you can be a passive investor, and the stuff Paul's talking about, there's obviously nuances to it and different regulations about how it's applied. And you certainly want to talk to a real estate CPA, not just any CPA, but a CPA who understands commercial real estate and understand what kind of strategies and techniques you can employ for your own possessions. But it's certainly a strategy that many of us need to be thinking about before you think you can. You don't have to be a multimillionaire to start thinking about how do you pay less in taxes. You should be doing this now, no matter where you're at right now. You should be thinking about how do you keep more of your own money so you can make sure it's working hard for you. Because I think that's really the critical aspect of moving forward. And Paul, I know you spent a lot of time focusing on multifamily. We talk about multifamily, and now you're investing more in self-storage. I want to talk about multifamily and where you kind of see the market today.
Yeah, so I love multifamily. In fact, like I said, I wrote a book called The Perfect Investment. I still believe everything in that book. It's hard for me not to get excited when I talk about this, but I know we have limited time. You know, in 1995, the government thought that, and they said that anybody who could fog a mirror should be able to own a home. And you know, you and I were on a panel recently where I mentioned this, and of course, home ownership shot up from 64% to 69.2% by 2005. It crashed down again to 63% in the next decade to 2015. Every 1% loss is 1 million new renters in the renter pool. People, more importantly, learned that homeownership wasn't the great American dream we have been told since the 1930s or so. And so people realized, hey, maybe it's not the best investment. I just lost money. I saw my friend or my uncle or my parent lose money. And so baby boomers are the fastest growing group of renters right now, even though they're the smallest group in America. Second fastest group is, I believe, the largest group of renters is millennials. And of the 80 million or so millennials, over half choose to rent, not buy. Some of them can't buy because of record student debt and credit card debt. And they're not exactly a great group of savers on average. And so millennials sometimes also think, why should I be tied down to this seemingly overpriced contract on this house when I could maybe get new friends or new adventures or jobs across the country or across the world next year? Immigrants are another large group of renters, and they're playing an increasing role in the U.S. economy, and so is Gen Z. Gen Z by far, of course, they're very young at this moment, but by far rent more than buy. And so this is causing us to be able to look down the road for decades and say multifamily could very well be the perfect investment. Now, the problem is a lot of people around the world see it that way too. And I guess they read my book. I'm kidding. So we've got international investors willing to take a very low return just to get in, sometimes even zero return just to own a piece of commercial real estate in the U.S. We can't compete with zero cap rate. Some of them just want that for the currency exchange opportunity. Like, let's say some Chinese friends of mine told me. There's also IRA investors coming in at record levels. There's institutional investors coming in from the coasts to smaller assets, older assets, less stabilized assets. They're competing with you and me in Chicago, John. And so all these people are coming in. But in addition to that, you've got new ruse. Now, I'm trying to coin a phrase here on BiggerPockets, and I hope your audience will help me. New ruse are gurus who are new, meaning they weren't even investing in real estate in 2008. And that's okay. It's fine not to have been investing in 2008. But to be going out there now and training and teaching people that it's okay to overpay, saying it's different this time, it's okay to get 90% leverage and not worry about, that's bad. And so these new ruse are training and teaching investors things that could end up okay, and they also could end up disastrous. So for all these reasons, multifamily is just, in my opinion, generally pretty overheated right now. It's what caused us to move into self-storage and mobile home parks.
Yeah, I want to hit on a couple of things you said. First and foremost, you talk about the demographic of today's renters, and everything you said is spot on. You know, I take a little bit of a different approach when I think about it from a marketing standpoint, because I think of the actual renter, right? And they're getting married later in life. So they're not in a position to want to own a home because they're getting married on average a few years later. I think the average age was like 27, and now it's up to like 32 or something like that. So they're getting married later in life. They want to live in the city. They value experiences more than they value money. So they want to experience things. They want to go out with their friends. They want to have great dinners. They want to travel the world. So they don't want to be tied down to a home. Many of them like the flexibility that comes with being able to travel, or if they got a great job offer in New York or out west, they could pick up and go and not have to worry about selling a house. And to your point, they don't value owning a home in the same way. They don't hold it up as the holy grail or the crown achievement of their life in the way past generations did. So for all of those reasons, you just don't have the same demand for home ownership. And then going back to the point you made about there being so much more demand for these types of properties, you hit on all of the reasons. The one thing I'll say, going back to foreign capital, is that you also have nations where the governments are a little, how do I say this nicely? You have more unruly governments where they are, they can take money if you put it in the bank or if you make it available to them. They're a little bit less scrupulous from that perspective. So, some of these people want to take their money and put it into something that is a bit more trustworthy because they're uncomfortable having it in some of these foreign governments and having their money sitting around. So with all of that combined, what you have is, and what we didn't even talk about was, and going back to your Nuru position, when you have the Jobs Act that made raising capital for deals a little easier for everyone, as part of the reason that we're able to do these kind of things. Well, now you have the doors open where now we can do our 506B and 506C offerings, and we can raise capital for these kind of deals, which we really couldn't do, or the knowledge of how to do it wasn't as readily available in the past. So now you have more and more people who are looking into multifamily and multifamily investment opportunities, and that is starting to really compress cap rates, making some of these deals harder and harder to pencil out and harder to find. So I know you've talked about transitioning more into self-storage. We're still, beating the drum and shaking down trees every day, trying to find deals that make sense from multifamily standpoint. I know you've transitioned into self-storage, but self-storage isn't necessarily that much better either right now, right? I mean, there's a lot of demand in self-storage as well, correct?
Yeah. By the way, I forgot to mention 1031 exchange investors as being a big role in that. I mean, I am selling an apartment building right now for a knowingly inflated amount to somebody with a 1031 who said, I'd rather pay you 10% more than it's worth than pay the government 20% in capital gains. Anyway, self-storage used to be, so there's 53,000 plus self-storage facilities in the U.S., about 76%. By the way, that's the same as Subway, McDonald's, and Starbucks combined. 76%, according to a survey I saw, are owned by independent operators, and a huge percentage of those are mom and pops that own one or two assets. Now, the problem is self-storage has become really overheated as well. In fact, if you look around Chicago, which I was there recently, if you look around lots of cities in the U.S., there are huge self-storage facilities going in old warehouses or being built. And so there are certain, it's even more than multifamily, it's hyper local, meaning I can tell you that Nashville is generally overheated for self-storage. I can prove this easily, but I can show you a section of Nashville that's kept self-storage out, and it's way under served for self-storage, and it would be a great place if you could find a way to build one there. And so it's very, very much based on a 3 to 5 mile radius. Okay. And so self-storage, while it is overheated, while cap rates are at by far record compressed levels like multifamily, there are still opportunities because of the mom and pop owners. There are mom and pops who leave huge amount of meat on the bone. They don't know how, or they don't care, or they don't have the resources to upgrade to bring them to optimal net operating income and values. And a great operator can go in, buy these, do those upgrades, and then quickly, as in 3 years, sell to a REIT for a very, very nice profit.
No, I love it. So there's definitely opportunities there if you can understand how to create value and create opportunities. I want to take that back and kind of do a bit of a comparison to multifamily, because I'd imagine that you also feel that, hey, there's got to be opportunities in multifamily the same way with self-storage, where yes, the overall landscape may be overheated, but certainly if you're looking in the right area or have the right business mind or creative approach to it, you can create opportunities. For those folks who are still looking in multifamily, what are some of the caveats or some of the advice you would give to be able to find opportunities in today's climate?
Yeah, so I think some of this stuff's probably obvious, but I think a lot of Class C and certainly Class D opportunities still have meat on the bone. There's still lots of upgrades that could be done, but buyer beware. I really think that, John, that a lot of times in a class C or C minus area, no matter what you did to that asset, the people who would live there would not be able to pay the increased rent. So I'd be really careful of that right now. Number two, I'd be really careful of over leveraging. A lot of people are fearful that there's going to be another recession. And of course, while multifamily had an amazingly low foreclosure rate, in fact, it was 0.4% with Freddie Mac, for example, in the last recession, where single family homes were 4.4%. I think it was, so it was only 10%, maybe 9% as high as single family. And then now, since then, it's only been like 2% of the foreclosure rate of single family across the nation, with Freddie Mac at least. And but the ones that did get foreclosed, I'm guessing, were over leveraged. And so I would really watch for that. I would really watch for the terminating cap rate. I saw a deal today where the cap rate was assumed on the back end at 5.3%. Well, that very well might happen. But what if it doesn't? Check out, make sure there's really good, strong cash flow if it does or if it does not appreciate. Make sure there's strong cash flow. Rod Cleef was on my podcast, and he said he had a whole bunch of single family that they depended on appreciation to be profitable in the last recession. Of course, in Florida, values dropped about 55%, I believe, from 2006 to 9. And he lost everything. But he said, if that would have all cash flowed really well and he had longer term debt on it, he wouldn't have had a problem. So those are some things I would think to mention to people.
Yeah, those are great tips there. I couldn't agree more with those tips. And the other thing I'll throw out there is, look at your occupancy rates too. If you're assuming high occupancy, even though we focus on Class B and Class C assets, which typically do well in a recession, very similar to self-storage, typically do well in a recession. But nonetheless, people are going to lose jobs, right? You're still going to have some people moving. Even if you have some people coming down from Class A down to Class B or down from B to C, you're still going to have turnover that's going to take place. So you need to make sure you account for higher vacancy rates in your operating. You're probably going to have some bad debt because people won't be able to pay you rent. So you may have to do concessions. You may have lost leases. So there's different things like that you may need to pay attention to. So you want to look at your historicals and understand, will this property perform in some of these worst case situations? And that's really going to make sure you're in a position to hold on to the asset no matter what's happening around you. So those are some key things just to take into consideration and keep your eyes on. And then Paul, just going back to self-storage real quick, because I do want to talk about the recession-proof approach to it. But then also, when we talk about value add in self-storage, what does that look like? Because I think people can get it with multifamily. Okay, I'm going to renovate. What exactly are you doing to a self-storage unit to create more value?
Chris Benson from Reliant Self-Storage was on the BiggerPockets podcast in the summer. And when I met him a couple years ago, he started talking about value add self-storage. And I chuckled. I think I literally chuckled. I thought, well, I mean, I get multifamily. I'm adding carpet and lighting and fixtures and cabinets and paint and, even staging. But what do you do with 4 pieces of sheet metal and a piece of concrete and a door? How do you value add? Well, I was actually surprised, John, that the opportunities to do value add in self-storage are maybe even higher than multifamily. There's lots of ways to do it, but they wouldn't be the ways you might think. So a quick list, and then I'll dial in on one example, would be adding truck rentals, adding late fees, adding admin fees, bringing rates up to market level. A typical mom and pop is 20 to 30% below market level, bringing occupancy up to stabilized levels. 90% is stabilized in self-storage. A lot of mom and pops are 70 or 80. Adding a website, adding marketing. A big one is the obvious one, and that is this. A typical self-storage facility might have an acre or two vacant that they either have parking, like RV parking on, or maybe just, is a vacant field. Well, putting a climate-controlled self-storage and a showroom on there to sell retail items like locks, boxes, tape, scissors, raffle tickets, kidding, those kind of things can really, really add to the value. Now, here's one quick example. We invested in a Grand Junction, Colorado self-storage facility, and the occupancy was 80%, but the delinquency, John, I kid you not, and this mom and pop was 80% as well.
Whoa.
And yeah, they had no website that I remember, and they had no truck rentals. So let's just look at a few of these. So they took the occupancy up from 80 to 92% in the first 6 months. The delinquency was taken down from 80% down to 5%, which is the industry average in the first 6 months. But they also added truck rentals. Now, the truck rentals alone added U-Haul rentals, by the way, with no CapEx, no capital expenditures, just making sure they had a parking place for the U-Hauls and signing a contract with U-Haul and training the staff. They were able to add $3,900 a month to their net operating income because there was no significant cost. There's a little labor with it. That's $46,000 a year. Divide 46,000 by a 6% cap rate, and that increased the value of that facility by about $700,000. Well, you take that, and then the other changes they made, they were able to double the value of the equity in this facility in just the first 6 months. Very powerful.
Wow, love it. Great strategies there. And I think that really captures the opportunities that self-storage has to create value-add opportunities. We've talked about mobile homes a little bit earlier, as well as multifamily. So there are ways to add value. And I think the thing that Paul is hitting on is if you can focus on that value formula and find ways to drive up that value, you can create massive wealth, but then you can also employ some of these different tax strategies to keep most of it and create generational impact. With that said, Paul, I want to move on to our Bullseye Round. Are you ready?
All right, I'm ready.
How has a failure or apparent failure set you up for later success?
Yeah, one of the failure in wireless internet and also drilling oil wells in North Dakota, both of them reminded me and actually taught me that I need to stay in my lane. I need to pick one thing that I'm really, really good at and focus on that. And that was going to be multifamily for many years. But, like I said, we expanded last year, but at the same exact time we expanded, we also narrowed. And that is, my company, Wellings Capital, decided to stay in our lane even more tightly. We would only raise money for other best-in-class operators. So we really just do a few things really well, and that's it. So I think the thing I learned from all that is focusing on one thing and becoming the best you can at that.
What is the book you've recommended or gifted the most in the last year?
Yeah, it's actually the book called The One Thing, and that's by Gary Keller, the world's most famous real estate broker, and Jay Papasan.
Give me a digital or mobile resource you recommend for your business.
I love HubSpot because they've got a free version that's quite nice, and we manage a couple thousand prospective investors and people on our email list through HubSpot for free.
What is a daily habit that helps you stay focused on your goals?
Yeah, so I do these morning meditations. I study scripture, and I also do this journaling and affirmation thing in the morning where I basically make these declarations about my life and future.
What's one thing you know now that you wish you knew when you were starting out?
Yeah, I mean, if I can be super honest, I'll just reiterate the same thing, and that is I wish I'd have known when I was starting out the power of commercial real estate to generate income and create wealth.
What's one thing you know now that you wish you knew 12 months ago?
One thing I know now that I wish I knew 12 months ago. John, you're going to stump me, I think. I wish I've been studying Donald Miller, who's got a book and a system called the Story Brand. And I wish I'd have known the power of storytelling the way Don does 12 months ago. We're getting there.
Yes, great book. I love that book a lot.
Yeah.
All right. What advice would you give to a smart, driven college student about the real world?
I would say that if you can, go find a mentor. Now that could be a paid coach where you pay somebody $20,000, $30,000 to be in their coaching program. It also could be a mentoring program where you go and you say, look, I'll work for free for you for a couple months, couple years, whatever, and I will do this. Whatever you tell them you'll do it really well, so well that they're going to recommend you or hopefully hire you and pay you, even though you said you would do it for free.
Love it. All right, Paul, you're out in Virginia. Tell me the exact city you're in right now.
I'm in Lynchburg, Virginia, right in the heart of the middle of Virginia.
Lynchburg, Virginia. Give me the best place to grab a bite.
All right. So, my favorite restaurant actually was a vegetarian restaurant, believe it or not, even though I'm not a vegetarian, called Herbivore, but they just shut down. So there's some really good barbecue places here. Down the road from here a little bit, there's a place called Mission Barbecue. We really like that.
Mission Barbecue sounds good. Well, Paul, listen, you have given us so much great information. I love talking about kind of your journey, what you've learned, how not to lose money, and talking about really the power of commercial real estate, all the benefits that are there, why multifamily is a great avenue and a great asset class, some of the initial drawbacks right now because it is so heated, and kind of how you pivoted to self-storage and how we can all look at the value formula to create opportunities for ourselves. So thank you for coming on the show and sharing all this great information with our audience today. For our listeners who want to follow you and maybe learn more about Wellings Capital, what's the best way for them to get in touch?
Yeah, they can find me on BiggerPockets, but the best way to reach out to us is at wellingscapital.com. That's WELLINGSCAPITAL, wellingscapital.com.
Thank you, Paul. Take care, man, and we'll stay in touch.
Thanks, John. It's great being here.